Is this sell-off signaling that something might be changing about the economy and not just the stock market? Guy.
Well, I'm not sure it's about the economy, but I got to tell you, Karen Feynman, who's been doing the show as long as I have, I mean, she's not one to be hyperbolic, but I think it was the 14th of March, Karen said this was the most concerned she's been in years in terms of the market, and she was buying put protection, and that's proven to be somewhat prescient, quite frankly. And I think it's not about the economy. I think the economy is fine. It's about everything else that's going on. And there are a number of different reasons we can talk about. We can talk about bond yields going the wrong way. We can talk about things in the Trump administration. We can talk about technical levels. But quite frankly, they're all adding up to what we're seeing now. I think people got too complacent. And I think what we're seeing now is a continuation of something that started, quite frankly, in the beginning of February. So it's not about Facebook. It's not about tariffs. It's about something more. In my opinion, it's about the Federal Reserve putting themselves into the conversation on the wrong side.
Karen, how do you feel about the markets now, weeks after you made that call?
Oh, thanks for saying.
Well, it's true.
I'm concerned, but there are things that are starting to get enticingly cheap to me. So a couple of things I'll be looking to do is lighten protection. As difficult as that is to do, you know, you really want to hold on to it when it's so volatile, but I think it's too expensive right now to have that much protection. So, you know, we opened the show with a quote on GM. I'm long GM. That's been, you know, a painful one. There is so much bad news built into GM at this price. I mean, it's extraordinary. I don't know actually if it's Tesla related as a car company. Those valuations coming down are totally independent of that. It may be, but there's stuff that I'm looking to buy. I just think this is getting overdone. I don't love the uncertainty around, but you got to buy when there's blood on the streets, even if it's your own.
I mean, it may not be, signaling that the economy is doom and gloom, but this market sell-off may signal that we had been pricing in an economy that had been very good and that there was no room for error. And at this point in time, when we're starting to hear from, for instance, the ISM data today, all these manufacturers talking about tariffs and the impact of tariffs on their factory activity, you got to wonder how much leeway is there in these expectations, very good ones for the economy.
That's exactly the problem, and that's why I'm not 100% sure that this is over yet. I mean, technically, I think we have some more downside, but look at the ISM manufacturing today. We had prices paid going up, employment going down. That's not what you want to see. Those are the beginnings of a stagflationary environment. You have higher prices and no employment. People haven't had a raise for 5 years or longer. So to me, that's what the market has been pricing in since February, and I think we've done a pretty good job of talking about that. And you say, all right, well, now there's higher rates. How is that going to impact consumer spending? And when you looked at it today at about 9:45, 10 o'clock when this ISM data came out, you saw bond yields go higher, the dollar go higher, and that's when the market really accelerated to the downside. So until that's resolved, I think it's going to be very treacherous waters here.
Yeah, so you guys have mentioned a little bit about the consumer stuff. I mean, to me, there's been a tell this year, and it really has been Walmart and it's been Home Depot. I think you mentioned one of them in the beginning. I mean, these stocks did not rally when the market bottomed in mid-February. So to me, I think that was really interesting. And it was also interesting that as the NASDAQ shot right back up and made new highs in early March, the S&P never made a new high. And so when you think about the S&P 500, yeah, those big tech names that kind of surged back up and made those new highs, they're about 10% Apple, Microsoft, Amazon, Google, and Facebook of the S&P 500. It never made a new high. The Russell got back up there. Small caps did. The NASDAQ made a new high. So Walmart and Home Depot have kind of been telling you a little bit of a story. So we're trying to figure out, is there something going on with the consumer? I don't know. Did you see one of the hardest hit sectors today was were the home builders? I mean, I thought that was kind of interesting. So, to me, maybe we keep hearing from people. We just heard from Peter Navarro from the White House lawn. The economy is great. He actually called it the Trump economy. It's actually really the economy of the last president for all intents and purposes, if you think about it, because we haven't seen wage growth. We haven't seen job numbers that have been much above the last few years' average. And all of a sudden, if these actions that they're taking are going to cause inflation, that could be the very thing. Listen, man, interest rates haven't gone up that much. Where's the 10-year? It's 2.73. You know where you started the year? 2.4. So to me, at the end of the day, I think there's a lot of self-inflicted wounds that are going on right now in this market and the economy.
Did he listen, man? Was that point?
He was manning you. I think so. You mentioned short-term borrowing costs, and it's the 2-year. It's the shorter end of the yield curve that has really gone higher.
Which is maybe I didn't make
that is tied to consumer mortgages.
Dan's been away for a while. I know you've been in California, but that is my point. I think the back end of the curve is stubbornly low, and the front end continues to grind higher. I mean, I don't want to get wonky here, but LIBOR, something nobody ever talks about, is at levels we haven't seen in 8 years, and it's gone up in a parabolic hyperbolic way over the last couple of months. Seems to go up every day. What does that mean? I think close to $350 trillion-ish worth of
in
debt.
Assets, yeah. $1.2 trillion in consumer mortgages.
Is pegged to, so it's not insignificant. And we have talked about Deutsche Bank. I got no horse in this Deutsche Bank race, but this is a stock that's making a 2-year low when the rest of the banks until recently have been doing very well. There's something clearly going on, and I think it's manifesting itself in rates.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.